Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we talk to individuals, businesses, and organizations who are taking the lead and whose actions are impacting the well-being of their communities and the world at large.
Welcome, everybody, to Money with Mission. Really excited you're here. I'm really excited today to have my friend, Sep Bekam, with me. Sep, or Sep as we call him, I'm going to mess that up, Sep, is the founder and CEO of Bekam Investment Group. Their mission is to elevate the standard of living of the communities they invest in while keeping those communities affordable. Bekam Investment Group believes in using capitalism to make the communities they invest in safer, cleaner, and more desirable. So, Sep, thanks for coming. I really appreciate it. Let's dive into that a little bit.
Well, thank you for having me on, Felecia. It's a pleasure to be on the show.
So I'm excited. I haven't seen Sep in a long time, so we've been chatting for a while before we came on, so we've had a good chat.
Always a good chat.
I know a lot of you probably know Sep, but for those who don't, tell me how you got into real estate investing. Give us your background.
Most investors that I know, they found a little purple book by Robert Kiyosaki called Rich Dad Poor Dad. And I found one of his later books called Conspiracy of the Rich. So I was working as a full-time electrical engineer at the time. This is back in 2009. And I didn't feel like I was really fulfilled at the job. And to be frank, I felt like Milton from Office Space, just a depressed engineer, and you just feel like you're in the rat race. You're trading time for money. And I felt like what I was doing, what I spent so many years in college busting my butt off for, wasn't really paying off. Like I couldn't, for just the cost of living to live in the West Coast, I couldn't really achieve the goals that I dreamed of. And I remember sitting at my first job when I realized how much money I'd have to pay in taxes and how much I would keep left over. I had a goals list. It was really small, and I started crossing goals off. Like, okay, I can't buy a house. I can't take this vacation. So I just got to keep working 50 hours a week, and hopefully I'll be able to save enough for it. So there was a bit of a pain. And then I read the Kiyosaki books, and then that really opened me up to the concept of inflation and using real estate investing as a hedge against inflation.
So what you said is depressing. You know, you go to school, you got your job, the dream job, and you're sitting there looking at all the goals you want to do, realizing this is not going to happen. A lot of people would have stopped right there and just stayed in that engineering job, worked 50, 60, 70 hours a week, given up on their goals, or said, maybe I'll get a smaller house, or maybe I won't get married, or maybe I won't, all the things that people do. What do you think it was about you that made you look for something else?
Well, I wasn't an A student. Like even going through engineering, I wasn't top of the class. I was, B, C student. And I'd always just question things, even at the job and just everything. It's like, why do things have to be done a certain way? So I think just intuitively I was contrarian. Mm-hmm. So when I heard about this concept that Kiyosaki talked about in the books about inflation, most people hear the word and they think, okay, inflation, it happens. The Fed says inflation is 2% per year, meaning if you have $1, after 1 year, your purchasing power goes down to 98 cents. Uh-huh. And after 2 years, you lose another 2% off of that. But when you fast forward and you look over time and you see what the ramifications of that are, you're losing your purchasing power. You have, if your wages stay flat and rent goes up and cost of housing goes up, cost of food goes up, cost of, just everything, food, everything. Then it just has it's kind of like a wake up call. It's like, I got to do something because I can't just rely on my boss or my job to give me a raise to help me reach those goals. So I looked at inflation as something that happens to all of us. And then the Kiyosaki books kind of opened my eyes, showing me that real estate investing is a way to hedge against inflation. So this is a way you can protect your purchasing power. So you don't have to keep trading time for money, but you can actually have your money work for you, which was what Wall Street was supposed to do, but they don't, they do the opposite of that.
So you've said a lot, and I appreciate all that. And there's those people out there that are in their jobs, working, and they even love their job, and they have their 401k, and they're saving that way. We'll talk about those in a minute. Talk about that person who has their money saved in their bank account. Explain how inflation eats that away.
Yeah, so that's a good question. So I don't even know what the bank accounts are paying, like the savings accounts today, but
Less than 1%.
less than 1%.
Yeah.
That's how it was 10 years ago. And yeah, so you have, I mean, that's a lot of people think that that's a safe place to put the money, right? That or your mattress. And at least you get some interest out of that savings account. But let's say even if a savings account is giving you 0.5% interest, which some savings accounts, they're giving you like 0.005 interest.
Yep.
You're getting less than 1% interest on that, right? So if you're getting less than 1% interest in savings, and then inflation is 2% from what the Fed says, and if you think that it's actually higher than that, it's closer to 3%, 4%, or 5%, then you're losing money even if you're getting that minuscule return from the savings account. Realizing, I think, that we have choices, that if we only go towards where the billboards are, you drive and you see the billboards for the savings account and, mutual funds, then a lot of people think those are the only choices that we have, but there's other ways to grow the money. Those billboards don't talk about financial education or real estate investing or syndications or anything like that.
I appreciate that. Thank you. And so, guys, this is just simple math. You don't have to be a brain surgeon or a urologist or an engineer to get that figured out. If your money's earning 0.5% and inflation is 2%, you're losing.
Right.
So it was a big wake up call for me. It really was, because I was saving my money, doing exactly what you're told to do, and then I found the Purple Book also. So very interesting. Let's shift gears a little bit, Sep. How did you talked about how you started thinking about real estate investing. Talk about your first deal. How did you actually make that leap? Because that's kind of scary.
Oh yeah, especially for an engineer, because we have the reputation for being, as Russ Gray says, like overanalysis paralysis, right?
Yes.
We want everything to be calculated and be perfect. So that's what I did. After I read the book, I was actively looking for properties at the time. I was living in Orange County, and I was just looking in the backyard. And back in 2009, prices didn't make sense because the book taught us basically to look for cash flow.
Mm-hmm.
And the prices were a lot lower back then. It was right after the 2008 recession. So Orange County didn't make sense. And I started spreading out to other markets. Then I started listening to podcasts. I would have listened to your show if it was on back then, reading more investing books, just educate myself, financial educating, to the point where I can try to underwrite deals, like determine what a good deal is versus a bad deal. I started following other investors who were investing out of state. And I was getting a lot of pushback from friends and family at the time. Everyone, as soon as I said, hey, I'm thinking about going and buying properties in Phoenix, people were like, what are you doing? You're going to lose all your money. Your uncle so-and-so bought properties 20 years ago and he lost his money from a property manager. And you just hear all the negativity about it. And they ended up being right, because the first property that I bought after a year of reading that book, I lost, I lost money for 2 years.
Mm-hmm.
And you have everyone saying, I told you so, I told you so. So it doesn't really help you get out of the mess. But just had to keep educating myself, keep surrounding myself with other investors, masterminding to be able to solve those problems. So I started out thinking I was just going to buy a good C-class, affordable housing property, and ended up being a D-class property in a war zone. So it was not intentional by any means. And then I did that again. And again and again and again.
So talk about that first one. And I mean, we've talked about the reason you kind of got into real estate was that you looked at your job and the goals. You weren't going to be able to do what you wanted to do within the scope of what you thought you were. So you found the book, you read the book, you went out and you bought a property after analyzing it forever.
Right.
So, and then you realize you made a mistake, and which is the way it goes, you guys. You make a mistake, and then you figure out how to get out of it. Some people think real estate's the problem, which it was not the problem, right?
Right.
It's figuring out a problem, figuring out how to solve it. So right now, you invest to improve neighborhoods. Is that how you started? Or how did you think about that when you first started? You got this property.
Yeah, I wish I could say that I started out with very altruistic motivations, and I was just going to go in and solve the problems in affordable housing neighborhoods, but it was not my original motivation. Mm-hmm. My original motivation was just to find rental properties and get cash flow.
Yep.
And be able to keep working my job and then retire in 40 years. I'll just buy one rental property a year. Mm-hmm. But because because so many things were going wrong, because that first property was a fourplex and then the second one was right next to it. So it was an eightplex in Phoenix. I mean, we couldn't keep occupancy of the properties greater than 50% for 2 years. So we'd get a tenant in and then a tenant move out of another unit. We'd have problems collecting rents, and I had to let go of property managers. I took too long to let go of property managers because I didn't have a reference point.
Yeah.
I was getting a crash course in real estate investing that I didn't really learn from the books. I think most of the education came from just doing it. Not that the books and everything else wasn't important. It was vital to get started and to keep going. But it was basically through burning my hand on the stove so many times. Most of the time, people, when they burn their hand on the stove, they don't want to touch the stove again. But I looked at it as, okay, well, now I got gloves, and these gloves will protect me, so I can handle the hot food on the stove and not get burnt. So that's kind of what the experience was. And then after I bought a couple of properties, I tried doing a flip in an A-class neighborhood, like a nice like Beverly Hills type neighborhood in Phoenix. Okay. And it was the least profitable deal I've ever done. It wasn't exciting. I mean, it was boring. You take a nice property, you make it nicer, you just make it more expensive. It doesn't change lives. It doesn't provide more affordable housing. It's not tackling the affordable housing shortage in America. So I realized that's my core competency, my team's core competency is in doing what we started with and what we're doing to this day. And that's for me what's the most enjoyable, because you can invest your money into positive causes, like you say, and not necessarily just through charity, but having a good mission behind the business.
I love that. And what I really, really like about it is, like me, we started real estate investing with other reasons in mind, and came to, we need our money to make a difference. We need for our money, and we want to help investors' money to make a difference, not just for them, 100% for them, but also for somebody else. And we just end up with the projects that we have. I'd love that you go to neighborhoods and buy up a whole neighborhood, fix up the whole house, fix up all the houses and rent them. And guys, he is not making them so that nobody can afford to live there. You're not changing the demographic of the neighborhood necessarily. Talk about that a little bit. How do you keep from changing the demographic incredibly, making it unaffordable? The gentrification, the bad word gentrification of those neighborhoods.
That word does like value add. It does have a bad reputation, and I think it really comes down to the asset class. So I started out as a multifamily investor. So after that eightplex, did a 6-unit, did a 58 unit apartment complex. And there's a difference between how apartment buildings are valued compared to single family houses. Single family houses, if you have 2 identical houses, one is your house and one is a neighbor, and they look the exact same year, same square footage, everything, and your neighbor sells it for $50,000 more than what you bought yours for, both houses basically have a valuation of the same price, the sales price of that day. That's not how it is with apartment buildings. Apartment buildings, it doesn't matter what your neighbor's, it does matter to an extent what your neighbor's property sold for, but an appraiser evaluates an apartment building on a commercial appraisal. So what that means is they look at the income of the property and how much income is it generating. If the deal is not profitable, it has a lower valuation. If the deal is very profitable, it has a big valuation. So with multifamily investing earlier on, I found myself incentivized to go in and improve the property, but also jack up the rents, find ways to cut the expenses. I'm a capitalist. I think it's fair for a business to be making profit. Actually, it's essential for a business to be making profit. But I didn't like that there was a conflict of interest, because for us to succeed as the multifamily operator, it would be costing the tenants more and more money every year. Like you have to raise the rents every single year. You have to find ways to charge. This is going to sound like I'm trying to demonize an asset class, but I'm just talking about for the multifamily, for the affordable housing sector.
Okay.
If you compare that to single family, if you buy the property cheap and you force the equity, you improve it, you get the carpet out because it doesn't last well in affordable housing neighborhoods. You put in luxury vinyl plank flooring, you put in granite, you make it more resilient. You can provide affordable housing and not necessarily have to milk the tenants every year. Like you charge a fair rent, but you don't have to raise it 15% or 10% every year just to be profitable. So it's a win-win for the tenant, for the landlord, and then for the neighborhood as well. So that's kind of why I gravitated more towards the single family portfolios, is because it's just mutually beneficial. We want the tenants to be happy, we want it to be affordable, and we want to give them the value add without it being a one-sided relationship.
So tell me how that works. Does it work well with buying one house at a time, or seems like it would be better? And I know what you do, you buy volume. And I think that's a big part of it. I think that's hard for people to get their head around. Talk about that a little bit.
Yeah, volume, I think that's a really important component. So I don't self-manage. My company doesn't self-manage. Everything is third-party managed. So if we put ourselves in the perspective of, how does it profitable for the property management company? Like if the investor actually puts themselves in the property manager's shoes and looks at it from, if the property manager is considering taking on a new customer, for example, and let's say an investor has one rental house in the market and takes it to that property manager and says, hey, I want you to do a really good job with this house. I want you to make sure the tenant's taken care of, do all the repairs and maintenance on time. Let's keep the rents at market or even slightly below market. Let's have a game plan. It's going to be hard to get their attention if it's $1,000 rental and they're charging 8% management fee. That's $80 a month. So for $80 a month, they have to do the accounting, they have to do the rent collection, they have to do all these things. I mean, it's tough, right? Like that's kind of like, brain damage to do it. Yeah. But then if you give that same property manager 30 houses or 60 houses or 100 houses, then you go from being, using an analogy, you could be a thorn on their side versus being, a volume customer. It's like economies of scale. So I kind of compare it to like the Costco model versus just, buying one-off products. Costco, they can negotiate better terms with their vendors, and their vendors pay attention because they know Costco has volume and there's economies of scale. So it's worth their time to take care of Costco versus if someone just goes and buys one orange from the farmer or whatever it be.
You talked about how that's beneficial to the management company. Talk about how it's beneficial to the investor that you purchase this way.
Well, the analogy a lot of multifamily gurus use is if you have an apartment complex, let's say 100 units compared to a house, they say if the house goes vacant, then you're at 0% occupancy. And then the apartment complex, if you have one unit vacant, then you only have one vacant and you have 99 occupied. What they don't say, I mean, that's kind of like comparing a Pinto to a Ferrari. I think it's better to compare Ferrari to Lamborghini. Compare a 100-unit apartment complex to 100 house portfolio. Because both, then you're going to have vacancies, right? So for both, you underwrite having vacancy in there, you underwrite the expenses, and just from an operations standpoint, you still treat it like a business. Because especially if you're doing more affordable housing, there's a huge need for it, but it is still a business. Like we still got to make sure that everything is basically just like in the apartment complex, like the vendors are being paid on time, that you have a system to take after hours emergency phone calls, that it's not just you buy the houses then they magically go up in value, because they might not, right? It might be in 2008 or depending on the market cycle of the market itself. So
2020.
2020.
I think I hope you guys heard that 100-unit apartment complex, 100 single-family houses. It's the same kind of model. One, you have a group, so you have an investor invest in Sep's 100-house project. They will be able to make money across the board of all those properties, not just having one single-family house where people invested with him, which I think is amazing. Besides the fact that you actually make a big difference in a neighborhood by buying in bulk like that. You can buy the whole street and fix the whole street, which raises the property value and everything. And so you have like you said, your forced equity, appreciation, tenants that are living there and giving you cash flow because you bought right. It's not easy, you guys. It's not easy. Sep's been doing it for a long time, and he has some blisters on his hands from burning his hand on the stove. He's got dog bites. He's got lots of lots of injuries from his lessons. And that's why investing with someone like Sep, who has had the experience, who has built his business the way he has with integrity, is the most amazing way to go. Speaking of that, Sep, talk about, do you have any projects right now where investors can get in touch with you and work with you?
Yeah, we have so the investors we work with, they kind of fall into two different categories. Some of them like short-term investments and some of them like long-term investments. So the short-term, we have bridge lending where they can just be the lender on the property.
Uh-huh.
Those are typically 2-year terms. And then the longer term, that's more of a syndication model. And that's between a 5 to 7 year hold. And it tends to be, it's not just like a fixed return, but there's cash flow, there's equity, tax benefits and all that. So, I think the best process as far as like, establishing a pre-existing relationship, setting up a call, just an introductory call to understand what the investor's goals are and kind of, understanding which one may or may not be a fit and, best way to help them meet those goals. Which is
key. Anytime you're looking to invest with a person, a syndicator, the best part about it to me is that you get to know that person. You will be able to call Sep, have a call. He wants to know what you're trying to do. If what you're trying to do doesn't match what he has, he's not going to put you in that. He will send you, if he may know somebody, because Sep knows a lot of people, who may have what works for you and will introduce you to that person. So that's another big, big advantage of working with a real estate syndicator. I really love it. So we will have how to contact Sep in the show notes. So anybody who's interested in reaching out to him, as he talked about his debt investment, which is a fixed return, or an equity investment, which is a cash flow that you take a little more risk with that, but you also have the potential for a little more return. Those are both very exciting and I really like it. So I think that's it, Sep. What else? Do you have anything else to share? What can you think of that I didn't ask you?
I think one of the questions is that I get from a lot of investors is how's the real estate market going? And because we're 12 years outside of 2008. So 2008 we had the market crash,
right.
We had the prices fall, and then there was this big upside. And now we're in COVID-19, and I think if people are having a hard time finding deals or finding opportunities, I think they're like the mistake I made earlier on was when I found myself in similar predicament, I can't find deals and I kept getting outbid and all that, is I was chasing deals instead of solving problems. I think a big part of your podcast will help people just have an unlimited amount of deal flow and unlimited amount of good connections. Because when you approach it from an entrepreneur's perspective of, we're here to solve problems, then there's plenty of problems out there, right? I mean, even today, there's plenty of problems. So
plenty of problems, and there's nothing wrong with making money solving a problem.
Right.
So that's what social capitalism is. We're not just about making the money, but a business has to be profitable, and we want to raise the lives and improve the lives of other people. So thank you so much, Sep. I really appreciate you being here. Until next time, go out and give your money a mission. Send it out to positively impact the lives of others and your bottom line. Thanks, everybody. Talk to you later.
Thank you.
You've been listening to Money with Mission. There are projects happening right now where you can make a great return while positively impacting the lives of others. To learn more about today's guests or to download 7 steps to building resilient wealth for women, visit www.moneywithmission.com.